All right, so Brandon is off for the rest of the week, and at least was going to be off for the rest of the week. And I had some issues last night with the market outlook, so I actually texted Brandon, asked him, "Hey, can I do the market outlook for you tonight? Give you the afternoon off." He's gone the rest of the week here, and then I might not be able to do the market outlook tomorrow because then I'll be gone the rest of the week as well. And so that's kind of why I'm doing the market outlook today. And if you're expecting Brandon, you're getting me. He'll be back, right? He'll be back next week and after the 4th of July and to do it next Thursday, and then I'll be back next week as well. I won't be back till next Friday to do it. So after today, maybe there might be a market outlook tomorrow, but it would be early. It'd be kind of it might come out like before the market closes because I'll be leaving early tomorrow. So there might be one tomorrow. If not, this might be our last market outlook until next Thursday. So keep that in mind. And let's cross our fingers that nothing major happens between now and then. So I'm going to break down everything that's been happening this first 2 days of this week. My expectations of whether or not, are we now bullish, right? Because we bounced up today. And anytime the market goes up one day, we're bullish, right? And everything was going up today, not just the companies, was that the case? Is it still just a small number of companies that's dominating these returns? I'm going to break that down. What's really driving this action previously and now today, and then we'll take a look at our trade idea, the stock that's breaking out itself. We'll talk about how to trade it with a relatively bullish type of trade. So let's go ahead and get started. Today is Tuesday, June 27th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. And if you're watching us on our website, check out some of these other things over here on the right, including our Market Outlook live video I do when I do these Market Outlooks. Come down to the bottom, click this heart, it opens up this tab, hit that like button. Same thing here, click this thumbs up icon, it takes you to this tab, click that like button. Again, the more you do that, it really helps us out. It gets our content out to all of our followers on those platforms. The more likes and shares and retweets and comments and all of that. So that's why we always ask for it every day. We almost got to 100. That's our goal on all of our Market Outlook tweets, is to get over 100 likes. So again, if you're liking these day after day, thank you very much. If you're not, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the market forecast on the S&P 500. You can see the nice little rally we had today, up over 1%. Bigger range, 49-point range. The ATR is at 41, so good range here. Over 1% of the move of the index itself. Both the intermediate and market sentiment lines are still falling, though barely falling. The intermediate line's barely falling there, just under 75. The market sentiment line obviously is even falling less, and it's actually still above the 80th percentile in the upper reversal zone. So there is some consolidation there, but to a very small degree. Not surprising, short-term sentiment bounce. It was pretty much at the lowest level of this little decline we had, this little near-term decline. We had this near-term rally coming off of this bull tag over here. Let's do this. There we go. So off that low up to this high point. So we basically came down to the 38% Fibonacci retracement level of this move. Here, let's bring up the Fibonacci lines. And now let's draw this line up here. So we came down to that August high point, the 62% retracement of the correction. And the 38% retracement of this near-term rally, which was actually a really good one. I mean, considering the one before that was this little small move off that bull tag. So, I mean, that's a really strong near-term rally going right into that. Pretty much lasted the entire expiration cycle. You can see the near-term pullback started at the beginning of the expiration cycle. The rally lasted the rest of it. Over here, you had a couple near-term pullbacks at the beginning of the expiration cycle. It pretty much rallied into the end. Over here you had, again, a near-term pullback that started off the expiration cycle, and then you rallied until the end. So we've had 3 straight expiration cycles, 4 straight if you count the decline in this one. But before this, 3 straight expiration cycles where you pulled back at the beginning, the near-term line pulled back at the beginning of the cycle, and then you just had one big long near-term rally the rest of the cycle. This one just happened to have 2 of them. But before that, of course, you had one near-term rally in the middle of 2 near-term declines during the entire expiration cycle. So not all of them behave this way, but the last 3 have. And as of right now, this 4th one is. So are we going to get a 4th straight expiration cycle where we get a near-term decline early and then we just rally the rest of the time? Seasonally, that's actually the case. If you look at seasonally, the seasonality of the S&P 500, it is a rally until the end of June, a little bit past the expiration date, but you do typically get over the last 20 years. Now, granted, I mean, we're coming off of a low point here where we're typically, on average, we're up less than 1% a year at this time of year. Of course, we're at 14.5%, but still, from a seasonal standpoint, we would expect to get a near-term rally the rest of this cycle. And however far that ends up taking us up to the upside. Like I said, this was a pretty decent move here. That was actually a pretty decent move too, but you would argue that this was probably the biggest one out of the 3 months in terms of how bullish it was over that near-term cycle. So we'll see how bullish this one is. Of course, we already have been in this intermediate rally for 3 months, and the intermediate line is falling and is actually below its market sentiment. That's a little different than the rest of these. It got slightly below it over there before turning right back up with the cluster, no less. And now we're a little more easily below that. So let's see how far up this near-term line goes. A good chance it gets up into the upper reversal zone, considering the momentum line made it to the 90th percentile. So there's a good chance, but let's see how far this goes. One day, of course, doesn't mean that we're necessarily done here. All the market forecast charts look exactly the same right now. So, I mean, it's to varying degrees of their long-term sentiment. You can see the intermediate line and market sentiment line are falling, but they're closer to 60 than 80 on the Dow. So a little bit more bearish from that perspective. On the NASDAQ, market sentiment's higher in the upper reversal zone, and the intermediate line still above 80. So you don't have the light pink shading there. So there's that. And then, of course, your Russell 2000, which has been the most bearish, its market sentiment line is still actually rising, but it's at the 40th percentile with the intermediate line falling there. So you've had pink shading here for a while now on the Russell, and you just barely got it on the S&P 500. So significant differences just in terms of the extent of the long-term, of the intermediate-term sentiment. The short-term sentiment looks exactly the same on all these indexes. It's a new week here on the weekly chart, and we talked about the beginnings of a transition candle because we got the lower high point. As of right now, we're getting a lower close. And again, we're only 2 days in, but we're getting a lower close, and that's kind of the sign. We've seen this before. You get the lower high, and then you get the lower close in the transition, and that's why I expect that we'll get more of a decline, especially with the Akinyashi differential below its average being at a high level. So that's still on the equation, on the table. The whole moving average we talked about as well, it's still red despite today's rally. It's a transition candle there on the daily chart, but despite the rally, it's still red. The parabolic SARs are still above us, so we're still showing a bearish pattern there. We never did get to strong bearish candles yet, but let's see what ends up, what kind of follow through we get on that. So there's still signs of weakness there. You look at the 3 green arrow chart. We don't have 3 green arrows in either one of the charts. Luckily, we don't have 3 reds. We got the closest on the Russell to 3 reds, and then your diamonds are pretty close to your NASDAQ, and your S&P are still pretty far away. But there's still 2 reds across all of these. So we're not back to 3 greens yet on either one of those charts. The DMI, I mentioned before that the positive indicator has fallen below the ADX. It typically means the run is done. I mentioned today that today's candle looks very similar to like the February 13th candle we got on the S&P. When we were kind of consolidating there, the ADX was much lower, but very similar type of move where it looked like we were kind of bouncing back up and getting going again to the upside, only to come to the 21st when we finally kind of broke down. Again, different ADX there. A lot of other charts look similar, but here, this does not bode well for this to continue up to the upside. Not when the positive is already below. You can get like here, you got to bounce back up above on the negative indicator back above, and over here you briefly got a positive. So again, kind of a similar move here, but then you were right back below the ADX, and the positive and the negative indicator ended up getting above it. The negative indicator is nowhere near getting above it now, but it's unlikely the positive gets above it too. So a lot of people talking about how bullish today is, and you see how we're, the bullish trend. It's like you get one day. That doesn't necessarily mean that a lot of these kind of reversal patterns we talked about on Friday have changed. You did get it back above 60 on the RSI. You did get back above 0 on the CCI. So both of these are at relatively bullish levels here. So that's a positive development. The Ichimoku trend, remember we got above 5, we got above 80. And usually when you're in a mature trend, the sign is not to break below the blue line. It's actually breaking below the green. We're still below the green line. So we're still got that reversal pattern working against us as well. And then finally, you did not bounce back above into the upper quartile. As good as today was, you're still in the middle quartiles of the Bollinger bandwidth, and the bandwidth is falling there. The momentum is falling towards potentially red arrows. You're easily below the Keltner channel. So again, as great as today's move was, it wasn't a move back up to the upside. It was more of just kind of a bounce back up off of a low point. Even your stochastics is not back above its moving average, and your Arun indicator, when we look at the Arun, the weekly chart here, I mean, we got a higher high and a higher low. We didn't get a new 4-week high. We're not even close to it. So we'll see. We're actually at the point of control for the 4-week chart, which is a significant resistance. So we'll see if we can break through this. We filled in gaps, right? We filled in the rest of that gap. We filled in a good chunk of this gap here. So a lot of these gaps we filled in. The only one really we haven't filled in yet is this one from the Tuesday after expiration. But we filled in the rest of those other gaps, and we've hit resistance. So now let's see what ends up happening. Remember, the low point is going to end up moving. It's going to stay at 0 here for a while because you're going to move. This one's going to move over, and then this will be the low point, and then this day will be the low point. So it's going to, the red line is going to hover around 0. But the range is going to continue to tighten up, right? As we're not getting new highs and we're below 70, that range is going to continue tightening up and setting us up for what could be a breakdown. So ideally in the next 2 days, if we want to be bullish, we need to get a new high point. We need to break through up here, fill in the rest of that gap, get it to a new high, and get going again with 3 green arrows, and maintain this intermediate trend that we're still on. Just keep it going for however long we can get it to go. What we don't want to see is any kind of failure at this point. Looking at today's volume and trading range, I told you the range was above the average. The volume was a little bit below the average at 72 million. So when you put those numbers into context here, we're still at right around 1%. On here, and the volume was at 72 million, was here below the average. So we're, the averages are still low. We're not breaking down below 1%. We're not breaking up either to 1.5, where you do start to get, of course, that's when you start to get the intermediate declines, right? When you get up to the 1.5% mark or above, you can see the correction here. So we're still at 1%. We're not below 1% where we can just now grind away to the upside, as you can see some of these others. But we're also not above, we're also not moving higher yet. So let's keep the ranges small. Let's keep the volume below average as well and get it down towards these lower levels. And that kind of goes with the money flow. Keep the money flow strong up above the 50% mark here, keeping the upper half of the chart. Again, we're still very, very strong on the money flow, though we're not, back up to where we need to be yet. Getting closer, getting much closer, but still, when you look at, where we've been, even at this August peak, which we're above right now in price, we're still nowhere near that level in volume. And you look at some of these other levels here, you kind of peak, we're below this level, this little peak right here in volume. We're easily above it on the price. We're still like, we got a little bit above it here at the peak, pre-expiration peak. We're actually back below it now. So, you would think that, we've been 3 intermediate runs, we'd have some really good volume move to get above that peak, because that's pretty much near the low point. But that's just not the case, and that's still continues to be a struggle. The other thing too that stands out about, the only 7 stocks going up crowd, all these other rallies, when you're on a bullish trend, pretty much the McClellan Summation Index stays above 500. It dips a little bit below during pullbacks, but then gets right back above positive 500 and stays there. And then once you get below it, then you're starting to run out of gas, right? Here it couldn't stay above it, and it was a good sign we were running out of gas on this run. Well, this entire intermediate rally, which is about a 23% run, if you look at the zigzag here, where's zigzag? So if you look at the zigzag and you change this to a 10% decline, so this is about a 23% rally off of that level. And really, even if you look at this current one off of this level, off this low up to this high point, you got about a 17% move on this current run. It's a pretty good move. When you look at the McClellan oscillator, we never did, over here we did get above 500. On the August one, we got above 500. We did not get above positive 500 yet. The oscillator did get above 0, but not above positive 35. So we're not bullish enough to, from a breadth standpoint, be strongly bullish. And we've looked at these charts before too in the past, the new highs and new lows. Let's see if it's been updated here. Yeah, so you're still at negative. This is for the New York Stock Exchange and the NASDAQ Composite combined. You're still at negative numbers, and you're still below its 20-day moving average. When you look at you did jump back up above 320. You're still not above that peak, and you're above the moving average. But again, we're not nearly as bullish as we've been on other peaks. Even this February peak, the exhaustion gap, we were way more breadth than we have right now. And then it's even worse when you look at the 200-day. The February peak got well above 380 on this, and we're just barely above 300. So we're still lacking the breadth. And when you look at the QQQ relative to IWM, just a couple of days ago, we finished above 2. This is the first week that we finished above 2. The first time on a weekly chart that we finished above 2 there. The Qs are still unbelievably more bullish relative to IWM. That hasn't changed. So it still is a matter of, other stocks are rallying higher, but there's they'll have good returns, like a Delta Airlines, for example, which got a cluster today and broke out. But it's such a small percentage weighting of the overall market that its returns don't matter on a market level. Of course, it matters if you're a trader or an investor in Delta. But Delta rallying doesn't have an impact on the S&P being bullish and the market itself being bullish. And so it still is a matter of a handful of stocks that are pretty much dominating most of the returns of the market. Let's transition now to the volatility index. It was down today, but it is up at least back above 80%. The correlation, the VVIX was down too, so the 10-day correlation is moving higher. It's still below 50%, which is not, which typically leads to a bullish pattern for volatility. In fact, there are, again, I've mentioned this to you before, but there are multiple factors that suggest volatility is due to rise. Multiple factors. And I mentioned to you before, we talked about it a lot today in our class on our website. and this being one of them. So the VIX continues to be kind of at this stage where it is due, right? It is due for a move to the upside to catch up to where pretty much where the VVIX is, right? The VVIX hit its low point earlier in the year, where the VIX was up in the low 20s. The VIX has since gone down below 14, and the VVIX is up a lot higher, closer to the 90s when it had bottomed out below 75. So that's a divergence that usually plays out in the VIX catching back up to where the VVIX is, not the other way around. And we'll see if that ends up coming into play here. Again, it's typically a seasonally bearish time of year for volatility, but considering that volatility has already been bearish and has already dropped, and we looked at this before, but you look at the rate of change for the VIX over whatever periods, right? And you look at this on a weekly chart here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15 week rate of change on the volatility index, being down to 46%, that's a very, very low level for 15 weeks. And it's generally led to a bounce back up into a 15-week period of stronger volatility, a positive volatility. So again, a lot of factors that suggest volatility is due for a rise. It's just a matter of when it will happen. Like, will it wait for the seasonal bottom of volatility, which is at the end of July, and then you have the run higher, or will that be pushed forward a little bit because we've already been so low on volatility, down 40% year to date, whereas typically at this time of year is up 3.5% a year to date at this time of year. So we might have pulled this low point forward, considering all the other factors that would suggest, including the positive correlation with the S&P over the last 2 weeks, as well as the low of the volatility relative to VXV, the 3-month volatility, having dipped last week, finishing below 80%, way below 80%. Again, that's a very extreme low point. And again, we've talked also about the before we've talked about the range of volatility and the consolidation. And you can see, when the volatility consolidates that range, here, let's zoom out so we can see some perspective on this. But when this range consolidates, being down below 10%, this 10% line, it's one thing for it to drop below 10% on a peak, which is what it does, right? It drops below 10% on a peak. It's another for it to drop below 10% on a decline, like it's been doing, and it's doing again. So in other words, volatility is compressing. Another sign that volatility is due for it to decompress, right? To uncompress, to actually widen out. And of course, you wouldn't expect it to widen out down to 10. It would grind its way towards 10. It would widen out in the other direction. All right, now let's talk about what's driving a lot of this price action. You can see the 3-month returns are still dominated by U.S. equities, in particular large cap, mega cap names. Remember, the Magnificent Seven make up about 57%, 57% of the Qs. So I mean, this is the Magnificent Seven here. It's still, it's still what's really driving a lot of this. Commodities, however, are now not participating. They haven't for a good chunk of it. They participated early in the 3-month period, but they're now negative. Let's look at what happened here today alone. So let's go to June 27th, and we'll go to that 5-minute chart. You can see, okay, well, it's the same thing, right? The Qs, IWM actually both rallied today. Real estate's kind of been linked to that area of the risk appetite as well, so it rallied too. But look at commodities dropping 1.6%. That's not necessarily the most risk-on move. Bond yields rallied. So bonds were down, and then you can see the dollar was down. So that's actually pretty bullish. What's interesting with the dollar being down, gold was down more, and commodities were down. So the weakness in the dollar didn't necessarily help international equities outperform U.S., which it typically does. And weakness in the dollar typically helps gold do well on the absolute basis, if not on a relative basis. And it really did poorly today. And then also generally helps commodities do well, but commodities really had a down day. Let's take a look at their chart. So they pretty much have had a pretty bad week. You can see the MACD has crossed back below its moving average. Stochastics is out of bullish territory. That's a pretty big breakdown. We've broken below. We had gotten above the 50-day, but in just the past week, we've broken below all these moving averages. So pretty bearish for commodities, and that's not. I mean, while it's good for inflation, at least from that level of inflation, it's not the best sign from an economic standpoint, right? A growing economy with companies that have growing earnings and everything depends upon commodity. I mean, if commodities fuel that growth, commodities typically don't correct, and my definition of correction is trading in the gap between the 50 and 200 week moving averages. Commodities typically don't correct during bullish markets. They typically rally off those lows, and so that's an issue that we see right now, at least that I see going on. Gold, of course, is still in its own pullback. It's been pulling back here. That's going to be something that's an issue with the dollar, and you can see bonds have converged so much that all these weekly moving averages are pretty much sitting right at the point of control. So bonds, I mean, talk about a lot of potential energy waiting to burst into active. That's where bonds have just been building into a bullish move that is set to jump at some point. And again, if bonds and stocks both rally, that will mean that inflation's ramping its ugly head again, and most likely will peak at a higher level than it peaked last time. But if bonds and stocks go in opposite direction, then that means deflation is the environment, and bonds would be rallying hard in a risk-off situation. But bonds are looking, really are set up for a really strong bullish move here. Here's the dollar and how it's performed. Again, it's converging alongside its point of control for the 1-year chart. So it's waiting for a breakout move one way or the other. Of course, we are forming, as of right now, a higher low point, a higher intermediate low point on the dollar. So the dollar, which had been in a strong bearish move, which is one of the reasons why we've been so bullish, right? You've had these strong bullish runs. We've got multiple bull tags here, and the intermediate line is pulled back but did not drop below its market sentiment, still in bullish territory. So you're looking for what could be a new move higher, new leg higher on the dollar, and for that matter as well on yields, right? And that combination of a strong dollar and higher yields is what's been that's been the problem for equities in 2022 and parts of 2023, as you can see here, going even into the banking crisis. Bond, the 10-year yield was at 4% there, and the dollar was rising, off of these lows. So that's not a bullish combination. At least hasn't been for equities. So if bond yields continue to rise, it probably not necessarily, it won't go up to 4.5% or anything. But if it makes a run back to 4, and the dollar makes its own run, and bond TLT kind of stays in this area here, and maybe retest some of these lows right around the 100 level, maybe a little bit lower. If that's the case, then that's not necessarily the best macro environment for bullish equities, especially considering how bullish equities have been, right? They went parabolic into that expiration, so we don't parabolic moves on the markets don't consolidate into a sideways action. Let's take a look at what the sectors did here today. So let's look at just the 1-day comparison chart here. You can still see the QQQ sectors doing as well as they've been doing over the past 3 months. But if you look at this a short time frame, they were the big dogs today again. So again, it's not necessarily only 7 companies that are rallying here, but if you look at the returns, here, let's go to the quotes here. And let's go market cap. If you look at these returns, they're getting the big returns, like every single one of these companies, from Apple. No, see, this isn't the S&P. Let's go to the S&P. Go public and S&P here. And then here we go. So from Apple all the way down to Meta, right? Outside of Google, which had a very small loss, you're looking at 3%, 3.8%, 3%, almost 2%, a couple 1.5% here. those are strong moves. And then you can see the rest of these big movers in the kind of AI space, 3% there, 2% for Adobe, AMD up 2.6%, all strong rallies in that, QQQ space in the market. So, again, it still is a large chunk of these sectors. And, if I were to look at the bottom end of this down here, there's some pretty good returns down here too. Newell Brands in particular up 7%, but it's the smallest market cap in the entire S&P 500. So it's got the smallest weightings. All of these, Alaska Air, Mohawk Industries, these are all strong returns and look good to say, it's not just 7 companies, but again, they are such a, you look at their sector weighting here. Let's go to their sector weighting, and you look at the top 8 companies of the S&P 500. Let's see here, weight analysis. The top 8 companies, so that would be because Google is 2, so you'd have 27% of those top 8, and then you look at just at the top, the 200, the bottom half of the S&P 500 only make up 10% combined. So that's, you need in a market cap weighted index that is so heavily concentrated, you need, like when we're bullish, we need those companies to rally and to do strong. And if they don't, if you start to see more of this ratio start to decline and break its 50-day moving average and start to fill in that gap, it won't be because we're bullish. All right, now let's take a look at our trade idea of the day. And I wanted to take a look at Zillow. Zillow is in kind of the real estate space, tells you what your home values are worth. It's had a really good breakout move. The intermediate posture is strongly bullish. We came close to a cluster, but not quite. Market sentiment is just getting into bullish territory. So it's got some opportunity for some growth here. You're 10% above the 30-day moving average, but that's not, it hasn't been, the highest level previously when you've been on a good run. This is chart. This kind of stands out as well. If you look at its weekly chart, we had just barely gotten all these transitions with a red arrow, and we just got a green a couple weeks ago on that transition, and now we're easily getting higher closes, higher highs, closing above the prior week's high. Good strong candles here, and some opportunity for that PPO to go up. Looking at the 3 green arrow chart for Zillow, we obviously have 3 green arrows. We're well above the value area. You're breaking through. If you look at my line here, my cursor, you can see how we had this ascending triangle that we kind of started to break out of yesterday, but really today is a clear breakout with good volume today too, and the MACD and stochastics rising up higher. This is what it looks like on the weekly chart. There's a gap here to fill in up to the 200 week moving average, with the MACD just crossing back up above its moving average. So you can see there's a lot of good opportunity for the stock to be bullish here, breaking out above 30. Well below 20 on the ADX, so that's a good sign. If you look at the RSI and the CCI, they're breaking up to bullish levels. Good sign as well. The Ichimoku cloud, we are well above the cloud and kind of breaking out now with the beginnings of what is at least an intermediate strength trend. And then you can see we broke above the upper Bollinger Band today, as well as the upper Keltner channel. Eventually it will show up here. So above the upper band and above the upper Keltner channel, and we don't have green dots yet. So we're just getting some bullish momentum that hopefully will lead us to the bands moving outside of the Keltners and getting a trend. So a good opportunity for Zillow to be bullish going forward. So what I decided to do on the stock is to do a bull put spread, or bull call spread, for August expiration, being 50 days out, buying. Selling the delta that's 20 at the 20 delta, buying the 35, so a little bit aggressive on the trade. So when you look at its profile, here we go. Let's give it. Here we go. You look at its profile and you see, again, small risk. What we normally do, about half our normal risk, and then going for about a 3-to-1 reward to risk ratio, which by August you can see we're right. It's pretty speculative, pretty aggressive. But if we maintain that bullish breakout, we can have a good opportunity here for a pretty decent reward for very low risk. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Subscribe to our website as well, marketscholars.com, for free. Follow us and like us on Twitter and Facebook. Have a great rest of your Tuesday night, everybody, and we'll see you all next time.